Good morning, everyone. I am Vinki Loomba, your host, a real estate investor, and every week I bring an awesome guest on my show who has an awesome success trajectory with lots of life experience to learn from. And today, our special guest is Lee Yoder. Lead a physical therapist transition into full-time real estate investor to follow his true passion to build his own business in real estate. He started with small apartment buildings. Today, Lee is focused on syndicating larger apartment buildings. He is a founder and visionary behind the Threefold Real Estate Investing, and he is committed to forging a path that will generate incredible wealth and opportunity for all involved. Welcome, Lee, to the Real Estate Vibe Show.
Thank you, Vicky. I'm happy to be here. Thanks for having me on.
Of course, I'm super excited to have you today with me, and we'll be discussing the real estate deals today from conception to completion. And before we get started, Lee, can you please share your background with me?
Yeah, absolutely. So as you mentioned, they're a physical therapist by training. So went to school for a really long time. From kindergarten to when I graduated grad school, 20 years. So I went to school for 20 straight years. I had to do 7 years of post-secondary school or whatever. So 4 years of undergrad, 3 years of grad school to become a physical therapist. Got out, did that for a while, enjoyed it to some degree. But then I got into home health physical therapy, which, I drive around to people's homes, mostly elderly people, and do physical therapy. So had a ton of flexibility. So that was great. It was great for my family, but I got really bored really quick with that. So after just a year of doing that, the company I was with actually brought me in to the office, and I became a clinical director. Was quickly doing no physical therapy, just working in the office, helping this startup company build a division. I was managing a bunch of therapists, and then kind of moved into like a director of operations role, which I loved. So now I was doing work that I really enjoyed. It was challenging, exciting, fulfilling, but now I had like no flexibility, or very little. And so it felt like this job is not as good for my family. Excuse me. So thought, okay, well, it seemed like, well, I can either go do a job like home health physical therapy, which I'm going to be bored at. It's not challenging, not fulfilling, but it's good for my family. Or do I keep this job that's a fun job? It's challenging, it's exciting, but it's not good for my family. So kind of just wondering, like, where am I headed? What am I going to do long-term? Just a few years out of school. And a buddy of mine that I was helping build that division with, he's my business partner today, but he handed me a real estate book. So read that, then read Rich Dad, Poor Dad, like so many people. And so then the gears started turning that, okay, there's like a different way of doing things. I need to kind of open my mind up. So started kind of networking, talking to other people. I had a buddy from church that was doing real estate full-time. He said, can you do your job from home? And for me, I mean, that's why I like to share this part, Vinki, because I think so many people now are working from home, and that really helps you be flexible. If you want to kind of start a side hustle, if you want to start working into real estate, it really helps to be working from home and to maybe have more flexibility. I didn't have that at the time. And when my buddy was kind of pushing me on that, I thought, well, shoot, if I go back to home health physical therapy, then I will have that. So that's what I did. I ended up at the end of 2016, I left the corporate job, took a pretty big pay cut, maybe like a 30% pay cut, and went back to home health physical therapy, still making enough money for my family. So I don't want to, make it sound like, we were living in the poorhouse or anything, but took a big pay cut, and went back to a job that I didn't enjoy so much, and it wasn't, fulfilling, but I knew I was going to start real estate as a side hustle. And that's what I did. It wasn't until kind of toward the end, a year later, toward the end of 2017, that I actually got into real estate. But that's what allowed me to do it, was I went to a job that gave me the flexibility, the bandwidth to be able to start real estate as a side hustle. So that's a little bit of my story, what led me into real estate.
And I read on your, I think it's on your website, you put a really good quote. I think I would say it's like your quote. You asked, like, if you did not have to spend the majority of your day worrying about making money or supporting your family, what would life be like? What was your thought process there, or how were you thinking to change the trajectory that you were on?
Yeah, good question. I mean, honestly, Vinki, I really like to work. So I was not trying to, I was definitely trying to work a little bit less, but it was really more about the flexibility, the freedom to work when I wanted to work when it worked for my family. That's what I was chasing. And it felt like, again, Read Rich Dad Poor Dad, started listening to a bunch of real estate podcasts and felt like, and it's, real estate's not the only way to do it. It's kind of, to me, like being an entrepreneur. So now as an entrepreneur where I work for myself, building my own small business, it's all real estate, but you could do it in other ways, but I think real estate's maybe the best way to do it. But it allows me now to work a good amount, probably the same amount as that corporate job, but it feels so different because I work when it makes sense to me. So, I was up pretty early this morning, decided not to go out, work out this morning because there was some stuff I want to get done. So I worked for a couple hours. Kids get up, do breakfast with the kids. I took the kids to school, and then I'm headed up to Dayton to one of our properties and was there most of the day, and now back doing this podcast. And so, and when I'm done with this, I can go pick them up if I wanted to. My wife's going to do that, but that's the difference is like, I would normally have been gone when the kids got up and I wouldn't have a chance to take them to school. So, and not that I don't have to worry about money anymore. We're not there, to that financial independence yet. We still need to work, but I love what I'm doing and I get to do it when I want to. So, I guess I'm still not answering your question. When I do get to the point where I don't have to worry about money, where, the properties that we own pay us enough that I don't have to buy more, honestly, Vinki, I'll still be doing what I'm doing. I think there'll be a little less pressure there, a little more freedom. I think, we're very involved with our church. We want to, do a lot of outreach. So sometimes I would love to go do kind of what I'm doing, but do it for others. If you've heard of something called Habitat for Humanity, where they go and rehab houses or even build houses for those that can't afford them. I would love to do something like that. So kind of doing a little bit of what I'm doing now, but not feeling like I have to make money for it. So that's probably down the road again, because we're not quite there yet, but I already have a lot of time freedom. So I'm already moving toward that, and it's awesome. I love it.
Yeah, because you're doing whatever you love. So when you're
Yes.
doing something that you love, it doesn't feel like work. So you enjoying
Right.
that. That's the best part. So let me ask you this question. Once you started, I saw in your profile that you were flipping houses. That's how you started in real estate. Is that a correct statement?
We flipped one house. Yes, that's how we
Okay.
got started. We flipped a house.
Okay. So then how did you get into the investing side of it when you started flipping homes, even one house?
Yeah. So it was at the end of 2017. We finally jumped in. We bought a house just in our hometown and we flipped it. I spent a ton of time out there, did a lot of the work myself. I mean, it needed a ton of work. So I hired a lot of it out too, but I put over 500 hours into that house. Took us 9 months. We did well on it, but the interesting thing, I felt like God gave me this great picture to kind of show me just very quickly that flipping is not investing, and flipping is really just another job. And I'd heard people say that. I listen to podcasts like yours, and I'm learning from these. And a lot of people that have gone before me, guys and girls that have done the flipping, but then they got into investing and maybe worked their way up to multifamily. They're like, flipping's fine. It's a good way to make money, but it's not investing because you're still trading time for money. And then when you sell, you're done. So that's the experience I had. And what was neat, like I said, what I felt like God just gave me this like clear picture was, as I mentioned, I took a pay cut for my corporate job. And then I wasn't working nearly as much, but then I added a flip on top of it. So now I'm probably working just about as much as I was at that corporate job. And then the money I made off the flip really just made the pay cut I took from the corporate job. So it was literally like, I made the same amount of money, and I just substituted 2 jobs for 1 job. So it was like, it's just jobs. It's just a different job. I'm just doing a different thing. I'm making the same amount of money, but I'm doing 1.5 jobs. And you know what I mean? So it was like, and then we sold it and we had nothing. So just pretty quick, like, okay, this isn't what we want to do. I sold my wife on this passive income dream and all this, and we get done with the flip and she's like, that's not at all what you said it would look like, So I said, yeah, it's not, that's not, having a rental and residual income and passive income and all that. So the next year, that took 9 months. Like I said, sold that, just a few months later, kind of at the end of 2017, we bought a duplex again, just in town. We ended up almost flipping that one as well. We probably owned it like 9 or 10 months again, but for a few of those months, cause we gutted the whole thing, renovated it. But for a few of those months, we had it rented. And so then we got to see, okay, every month, the rent that we bring in is more than our expenses. And then we pay ourselves and we're paying down the debt. And so we just proof of concept that like, this is investing. This is what it looks like when you buy a property, you get it rented, and your income is more than your expenses. And it wasn't a lot. I think it was, maybe $300 a month or something like that. But it was just that proof of concept. Like, oh, wow, if we did, it's only $300 a month, that's $3,600 a year. Okay. Not setting the world on fire, but it's something. And if we did this 10 times, that's 36,000. We do it 20 times, that's 72,000. Now we're getting closer to something like, hey, if we had enough of these, that would be financial freedom. Right. But that was kind of my next step. Vinki was like, I don't want to own 20 duplexes. I don't want to do this 20 more times. So I want to own more units. So then the next year we did a 16 unit and then quickly got an 8 unit and a 10 unit and just kind of moved up. And then 2 years later, we started into syndication. So that's kind of, went from the flip duplex and then just kind of stepped it up until we got up, closer to 100 units, what we're doing today.
Great. And now you think investing in apartment building is the best way to achieve financial freedom or financial success, right?
I would say that. I would say one caveat, Vinki. What I usually tell people is like, if you want to manage the properties yourself, for sure. Or if you just want to build a really small portfolio, but own a lot of it yourself, and maybe you have a lot of capital to put into it, I actually think I still think multifamily. I think multifamily is the best way to go. But I think maybe even small multifamily would be even better. And maybe you just do some joint ventures. So that's what we did on the 16 unit, 8 unit, and the 10 unit. We just brought in either 1 or 2 partners. We just did simple joint ventures, went and took those down, and the cash flow can be great. We were able to keep 50% of those for ourselves, even when it was my other partners that were really bringing the capital. And so we didn't do preferred returns, anything like that. So I'm getting 50% of the cash flow and, as well as 50% of the equity. So you can build up cash flow pretty well and achieve financial freedom. I think probably quicker if you do the small ones, but you're never going to scale that as big as you can with the big ones. And you're not really going to build a business. You're just going to build kind of you're going to be probably always going to be like a solopreneur. It's going to just be small and you're going to have a small portfolio, but you can build up your cash flow really quick and probably reach level 1 financial independence quicker. But if you have a vision of really going big and building a business and reaching level 2, 3, 4 financial independence or whatever, to me, that's where I think it makes sense to go bigger, to buy bigger multifamily. Because it just allows you to scale. You can get more professional property management, which we've learned means a lot, which with the smaller stuff, it's harder to do. So it depends what you want. If you just want cash flow and you just want to, hey, I just want to hit 75 grand a year and that's all I need and I'll manage them myself, I would get small multifamilies and just bring in 1 or 2 partners, do simple joint ventures. If you say, I want to build a business, I want to blow this thing up, I want to own 10,000 units, then definitely not small stuff. You want to go bigger and really build a business around it.
Right. So today we are talking about the real estate investing from conception to completion. So I gathered from this conversation was the first step is convincing yourself you can do it. Then convincing your partner, like you did with your wife, told her about the passive flow. So the third step is finding the deals that you were doing, like the small properties before, and then you figured out that you wanted to scale. But one thing you said very important in between was having the right team or finding the partners. How do you do that? Can you share that?
Yeah.
What was that experience like?
Great question. Networking is a huge part of it. Going to these events, I think that's probably what they offer the most of. You got to get around the right people. Sometimes it's through referrals, but I will say, my first partner was a mentor. That's really helpful. So I think people should strongly consider whatever that means. For me, I actually didn't have to pay for that mentor. He was the guy that was leading the apartment focus group at the local RIA in Cincinnati. And I ended up giving him a piece of my deal. So I did pay him once we sold that deal. So that was great. And I was happy to do that because he helped me so much. But he was my first partner. And then, family, friends, those close to me. Again, you could probably find these people at your local RIA or other meetups that want to invest. So I kind of had a partner that was really more like a money partner. And I did all the work. And then my other big partner, Vinki, was the property management company. That is, in my opinion, so important. If you want to kind of scale, if you want to grow pretty fast, I think getting a property management company to partner with you is so important because, just a quick story. When we bought the duplex, it felt like, man, this is scary. I can't believe we're doing this. We've never done this. But going from there to the 16 unit felt like just Mount Everest. Like that's the mountain we were trying to climb. Going to a 16 unit, it felt like this is an apartment building. It was a really big building. It used to be a school and someone turned it into a nursing home, then an apartment building. And it just felt like we're responsible for 16 people. This is overwhelming. How can we actually do this? But when we go out and we find the right property management company, they came out to the property with us. And for them, it was like, yeah, this is no big deal. This is easy. They were managing 1,000 units. So what's 16 units to them? I was going from 2 to 16. So I was, going up 8 times. For them, 16, that's what, 1.6% of their portfolio. That's nothing. So that gave me so much confidence. And they're the ones really doing all the work, as far as like just managing the residents. Like that part of it felt overwhelming to me and my wife of like, we're responsible for these people. What do we do if they have complaint? Well, we don't have to do anything. The property management company does that. So that's not someone like on your team, like in your business, but that is a partner to me. If you want to scale and you want to kind of grow pretty fast, if you can get the property management piece right, that's going to give you a lot of confidence because they are truly a partner to you on the specific properties that you give to them. And they have a lot to say about whether that property does well or not. So that's a huge piece of it. After that, I think another thing I would just say, Vinki, like when you want to actually add people to your team, like I end up adding a business partner, it was just telling people about what I'm doing. And I feel like it just kind of works out. Like even you and I, Vinki, we might talk after this and I might say, yeah, we might just be catching up and here's how things are going. Yeah. And we're kind of looking for this person. And you may end up referring some of that. I think the more you talk about it and you're talking about it to the right people, and it might be outside of real estate, but someone might say, hey, this person's just super talented, super organized, something like that. So that's probably how often you'll end up finding partners, just talking to people about it.
Mhm. So I'm going to ask you this question. How do you vet a property management company to make sure that this is the right fit for you?
I'll just say there's more to it than this, but to me, the number 1, 2, and 3 thing is just getting referrals, because there's just no way to know if they're going to be good or not. And I would want to hear from people that have been working with them for more than a year, because I feel like I've seen where property management companies can do pretty well for a year or so. And then I don't know, they grow too fast, they lose people, or they just stop trying so hard or something and they don't do so well. So the only way for you to know if they're good is if you've talked to people that have experienced them, that have been working with them and gone through difficult times and gone through evictions and big CapEx projects and unit renovations. And so you need to, that's where this networking comes in, Vinki, right? Where you know enough people in your area or in the area in which you're investing where you can say, hey, can you tell me about this property management company? And they can come to you and say, look, I've worked with them for 3 years. Here's the good, here's the bad. Here's why I keep working with them. Here's why I think you should. Go talk to this person. He likes this property management company. That's the only way. To me, the only way to really know before you've worked with them is talk to people that have worked with them.
So do you interview these property management companies or the property managers? What kind of questions do you ask them? Or like, what is the one generic question that you wanted to ask each and every property manager to make sure that?
For sure. Yes, for sure. We interview them again. They all look good. They all answer well. They all have good intentions. They all have things set up. They all know what they're supposed to do. I just want to know, are they actually going to do it? And the only way to know that is, people work with them. What I'll say though, that we like to ask them is, just how do you set things up like on the ground and how do you find your staff? And can we, maybe talk to some of those people, because you want a company that is set up really well. They have good processes and procedures, and they have this good back office and stuff. So that's really important. But the people they place on site are really going to drive your property, or not, or let it go. Right. So I want to know about that process. I want to know how they find people, how, what's their track record with that. Again, when I'm talking to others that have worked with them, how well do they do putting people on site, finding those right people to run it? Because again, they're the ones doing most of the work. When we talk to our property management company, we're almost always talking to the person on site, not the regional vice president. I mean, we talk to them sometimes, but not the regional managers, not the head guy that we, talk to sometimes. It's the people on site. So I want to talk to them a lot about that. How do you find those people? How do you train them? How do you keep them? Things like that.
Interesting. So in your immediate team, how many team members you guys are in your
Yeah, really, it's just me and my business partner. My wife is, she's also healthcare, but retired from that. She's an RN and she stays home. We do like a hybrid homeschool program. So our kids in school just 2 days a week, and then we homeschool 3 days a week. But on those 2 days, she works in the business. And then actually her sister does some bookkeeping stuff for us. So we kind of just have some family doing some work for us. And then I have one business partner.
So it's going great, huh? Between the two of or four of you guys. That's excellent.
Yeah. I mean, there's growing pains and, there's struggles, but yeah, it's going pretty well.
Awesome. So let me ask you this question. So we have taken care of so many pieces, like, when we get into the deal. So one important piece is finding the investors.
Mhm.
How you guys are connecting with the investors and how you're convincing them or how you're raising capital from these investors.
Good question. So, it started out just family and friends, because those are people that trust me enough to just invest with me and know, I'm going to at least do everything I can. So they trust me enough before I have a track record. Other people don't. They want to see my track record first, and I totally get it. So a lot of it has just been organic. A lot of times, people start investing with you, and then others hear it. But what we try to do on social media, that's probably a big part of what we do, is just showing what we're doing. And then people that, kind of have an interest in real estate, they start seeing that you're doing it, and they, probably know you or know somebody that knows you, or, they're in the area, and they just say, hey, looks like what you're doing is interesting. I'd like to talk to you about it. So we just try to let people know what we're doing. We try to provide some educational material on social media, on our website. We try to drive people to our website. And then just to get into a little bit of the technical logistics behind it, we use active campaign. So people that come through our website or, reach out to us and we get their phone number, email, we put them all on active campaign. And so then we send out a monthly newsletter that just kind of keeps in touch with those people. So they're getting a email from us at least every month. And then we'll, usually a couple times a year, try to, make a phone call and reach out to everybody. So we're just trying to keep everybody warm, educate them. They've already kind of raised their hand and said, hey, we're interested in real estate, but we just try to keep them warm so that when we actually have a deal, we're sending out to this list of people who we've talked to, we know, some of them still family friends, some of them friends of family or friends. And some of them just saw us on social media, and we talked to them and got to know them a little bit. And then we send out a deal, and then hopefully, 10 to 20% of them are ready to go right now. And they decide to jump into the deal that we have.
Great. So what was your first raise like when you started, when you syndicated the first deal? How was that raise?
Not too bad. It was family and friends, and then two people from the local RIA. So that helped. But we raised 550,000. And it did seem like a lot. I mean, the 16 unit, the 8 unit, and the 10 unit that I did raise money on those, but the biggest raise was $100,000. So this is 5.5 times that. So again, it was mostly still family and friends, but it still felt like a lot of money. And it wasn't super easy, but we had enough people, and we had exited some of those other deals. So we had already sold the 16 unit, already sold the 8 unit. So we were able to pay some of our investors back. So they were the first ones to jump in again. They're like, well, let's do that again. You gave me all my money back plus, a good bit more. So let's put that back in. So those were easy. And then just found a few more people. I'd say it got harder from there because we raised more and more. But the first one was just still very nervous because we hadn't done anything like that before.
That's good. The experience, right? That counts.
Yeah. Oh yeah.
That's good. So you have the investors on board. You figured out the property management company. So now, what is your strategy? You buy and hold 3 to 5 years?
Yeah, for the most part. I usually tell our investors, some of it is market and economy dependent. We always we try to stay simple just to not overcomplicate things. So when we present it to our investors, we always present it as a 5-year sale, exactly 5 years. We'll hold for 5 years. We sell. If we do that, here's what your return will look like, over those 5 years and at the sale. And then we do show them, hey, if we refinance at the end of 5 years, here's what that would look like. Here's your return. At 5 years, you get your money back, but you stay in the deal, things like that. But then we tell them if the market's really good, like it has been, and it's just gone straight up for a few years, we'll probably sell after 2 or 3 years and we have on a couple, like you mentioned, Vinki, we've gone full cycle. And that was like after a year and a half. And it was because we were selling where I thought we'd sell in 5 years. So if that happens again, then we'll sell early, most likely, and recycle that money. But if times are bad, then we may be refinancing at 5 years and selling in 7 to 8 years. So we want them to know that. We want them to know we're showing you what it looks like at 5 years. Could be earlier, could be later.
So when you get your hands on first time to the underwriting, so what was that experience like? What exactly you're looking for, or what kind of assumptions that you are, trying to add, or just like to make the numbers match to your expectations? Is it like something different now versus when you're doing it before, or any kind of, yeah, like a key or say light bulb kind of moment that happened throughout the time that you wanted to share with us?
Yeah, sure. You really, if you want to get into this as an active investor, you really have to learn to underwrite. I mean, you really do it. It's what tells you, how much you should pay and what your returns are going to look like. And the closer you are, obviously, the better you're going to buy and the happier your investors are going to be and things like that. So it's really important. You have to really learn. And that's where I think, you need to find a mentor or partner with somebody that knows how to do it, or get some coaching on doing it, because you really have to do it right. I would say, Vinki, like what I've learned from it, and I think what I've gotten better at is, it's complex. There's a lot of things to think about, but it's also the main points are kind of simple, still hard to figure out, but kind of simple. And that's just that you need to figure out, what am I going to be able to charge for rent? I mean, it's very important to gather all the data from the seller, right? And you want to dig into that. But frankly, that doesn't help you that much, because that only tells you how they operated the property. Why does that matter to you? Right. I mean, it might help you decide what you should pay for the property, but even that, it doesn't really matter. I mean, when people talk about buying at a cap rate, well, if you buy at a vacant building, I mean, your cap rate's zero, but if that building's in a great area and you can fill it up, then, you may have to pay millions of dollars for it or something, versus, you've got a property where you say, well, I'm, buying at a 7 cap, but if there's no value to add, then that might not be a good deal. So you really need to know how it's going to do in the future, not how it's done in the past. Now, the past can, help you predict the future for sure. I mean, but what I really care about, and what you're going to get paid for as a syndicator, as a sponsor, is to predict the future to some degree, as well as you can.
Exactly.
To say,
Yeah.
this is what we're going to get in rent. That's the most important thing. Where are we going to hit? And then the second question, Mickey, and this is really difficult too, what is it going to take to get us there?
Mm-hmm.
Are we going to have to, renovate? Are we going to have to add new windows just because it's a rundown building? Are we going to have to paint the exterior? We're going to have to put a bunch into landscaping. And then are we going to have to renovate the units? How much is it going to cost per unit? And then get that budget together. And that's the one thing I've learned too, Vinki. You got to raise more money than you think you're going to. Those CapEx budget, they're going to go beyond where you think. Your reserves, things are going to happen. We just got nailed with some big tax settlements that just really no way to see coming. And then Ohio passed a new law that made it even worse right when it was happening to us. So just like horrible timing. And we just, luckily we had a lot of reserves, but I wish we'd had even more because, you never know what can happen. So, and I would say, I wish we had even more on our first properties. We've raised more and more and more. So we've learned this lesson and we're doing better and better and better with it. But that's what I'd say. You're trying to predict the future. It's where can we get rent to? What do we have to do to get it there? And that amount of money, raise even more.
So when you're raising more, is it legal to raise more? First of all, that question comes to my mind. And the second thing is, how do you justify to your investors? Because, by the end of the day, if you're raising more, the distribution is going to be a little bit lower percentage, right? So
Yes.
overall, it's going to affect the deal. So how would you justify that to your investors?
Yes, it is legal. I mean, I'm talking about raising more before you close,
Right.
like going into. So yeah, you can raise as much money as you want. But yes, it does. If you're looking at a deal and you're saying, okay, if I pay 10 million for this and we raise, 3 million, and then all of a sudden we should probably raise 3.5 million. Absolutely, that decreases your returns. But what I'm saying is that's what you should do. And so if you can't buy that property for 10 million, if you raise 3.5, then don't buy it for 10 million. And I understand that's hard. I mean, that's hard for me. That's why, we've gotten ourselves, again, early on, I wish we would raise more and we're fine, but I think that's the mindset you have to have. If we need to raise the 3.5, even though that might mean we can't pay 10, now we can only pay 9.75, whatever, then your number's 9.75. So that's how you come up with your purchase price. And you've just got to be strict about it. I think you've got to be conservative to say, if I think there's a chance we're going to need 3.5, or if I think we're going to need 3 million and I want to have, some hefty reserves, then we got to do it. And if we don't win the deal because we can't win the deal by having enough reserves, then we're not going to win the deal.
Interesting. So what do you think about today's economy? Are we at the verge of recession? And now what do you think what the future is going to look like if we are in recession? I mean, for the investing perspective,
Yeah.
what is going to happen to the multifamily? Any predictions there?
Yeah. I mean, I'll just start by saying I have no idea, and I'm not a financial planner, but yeah, I will give you my
From your
opinion.
perspective, like you're looking
Yeah.
into the future now, right?
Yep.
Because if something
Yeah.
happens, how are you protecting yourself?
Yeah, and I love this stuff. I listen to ton. I mean, I listen to more like macroeconomic podcasts than I do real estate podcasts. I love this stuff. So I'm not real smart on this stuff, but I listen to a lot of smart people, and I love it. And so I do think we're headed for recession, and I think it's going to be worse than most people think. I think it's going to be pretty bad, and I do think housing is going to be affected. I think single family housing is going to be affected a lot. I do understand that it's different than 2008. That's fine. It's not going to be it's not going to be a recession led by housing, and there's not going to be a banking crisis. That's fine. That doesn't mean that we can't have a housing recession, that we can't have home prices drop and significantly in some areas. I think anytime you have a bubble, and I think we do, I think we have a bubble in almost all assets, it can be popped, and you don't have to know what's going to pop it. And you don't have to be able to look out and go, oh, well, that's really bad. Like, I mean, no one knew there was going to be a banking crisis. No one knew. I mean, some people did, but for the most part, the public, people like you and I, like we didn't know that what was going to, pop the 2007, 2008 bubble, but it popped. Something happened. And I think there's plenty of things out there right now. I mean, China is already in a really big, real estate crisis. I mean, could that spill over here? Sure. I mean, China's heavily invested in the United States. There's a bunch of things, but I think we have a bubble. So when you have a bubble, it can pop. The Fed is tightening now. They've raised interest rates already. That makes housing extremely unaffordable. I get the point. I guess the common pushback is just, oh, well, there's a lack of housing. That's fine. You can still have prices correct. I mean, people can stop buying, and that's what's happening. The home builders are already telling us that there's the demand has fallen off a cliff for new homes. So just because there's not enough new homes doesn't mean the demand can't drop. And I think they're going to start dropping prices. I'm glad I'm in multifamily. I'm glad I'm not in single families where it's based on comps. Do I think rent could be affected? Yeah, I think rent could come down. And I'm glad that we bought when we did, where, rent has gone up so much that we'd be okay with rent coming down. And that's where I think, Vinki, I just think, conservative underwriting is good, where you say, we're buying where the average rent is 800. We think we can get it to 1,200, but if we get it to 900 or 1,000, we're going to be okay. And so for us, like right now, we're pushing for 1,200. We're getting these. I mean, we've bought properties where we're like, the goal is to get to 1,000, and we're getting to 1,200. So if we correct back to 1,000, we're going to be just fine. We're right back to where we were in our original projection. If we drop to 900, will we not hit some of our projections? Yeah, sure. So we might return 6% to our investors instead of 8%. And, we're not going to be happy about that. That's not the goal, but we're going to be happy that we're not losing 50% in the stock market. If that's what happens, we're just returning 6 instead of 8. So there's a lot of safety in multifamily, and we feel very comfortable. And I would still buy today because I don't think I'm near smart enough to time the bottom, but I am being very conservative, and I'm not being that aggressive with buying because I do think we're headed toward a recession, and I think it could be pretty sharp. I think by this winter, things could look very different. Prices could be very different. So I am kind of being pretty, straight, like pretty, just not very aggressive at all. And I feel like I'm going to continue that to this winter.
That's good. So we are kind of out of time now. So I'm going to ask you, please share one golden nugget with my audience.
Yes, sure. I think maybe what I feel like I said the most was how important it is to network and how important mentorship and coaching can be, because everybody says that. But I think the reason I say this because it's so true. Like when I met the guy that taught me how to underwrite, the guy that was leading the apartment focus group for the Cincinnati RIA, when I joined that group and when I met him, he taught me to underwrite. Then he gave me the LOI to send to the broker. He looked at the contract with me. He helped me pick out a property management company. And then he got me into my first 16 unit, and I'm where I'm at today because of him. So if I'd have met him 2 years earlier, I'd be 2 years beyond where I'm at. And if I hadn't met him today, I definitely wouldn't be where I'm at unless, I met somebody else. But that's so important. I think you got to get out there. And you don't have to partner up with the first person you find. You don't have to pay the first person you find, but you got to get around people that are doing what you want to do.
That's good. So golden nugget is find the right mentor. And the next time I will do another episode on how to find the right mentor, right?
Yeah, sure. Yeah. It's an important one.
That's very important one. So this brings us to our rapid fire round. I'm going to ask you 5 questions. You will answer in 1 sentence or 1 word only. Okay.
Okay. Do my best.
Okay. what is one of the best skills that you have learned over the years that works for you all the time?
I would say underwriting.
Great. What is the best book that you have read or recommend other than Rich Dad Poor Dad?
The Compound Effect by Darren Hardy.
Oh, I like that one too.
The good
What
one.
is your biggest passion?
I would say, I'm a Christ follower, so I'm a man of faith, and that and my family is my biggest passion.
In one word, what does life mean to you?
Ooh, for us, it's honoring God. That's 2 words, but that's what life's about for us.
Great. If you get a chance to change something in your life right now or even going back, what would that be? And why would you do that?
The first thing that comes to mind, we'd live on a farm,
Mhm,
like a big, huge farm.
mhm. So that's the one thing that you wanted to change?
Yep.
You don't
Yep.
want to
We
live on
we
the
we,
farm?
we have 4.5 acres now. We kind of have a mini farm. I love it, but if I could change it, I mean, I'd need somebody else to buy the property for me, but we'd live on like a 150-acre farm.
Wow, great. That's awesome. So how
Yeah.
can people reach out to you, Lee?
Go to our website. It's a great spot. We've got, like I mentioned before, we've got some things about us there. We've got some educational material. You can connect to us through there. You can find my webs or my podcast through there. But that's Threefold, spelled out THREEFOLD REI. So threefoldrei.com. Check us out there. I'm also pretty active on LinkedIn. So if you look up Lee Yoder on LinkedIn, you'll find me.
Thanks, Lee. I really enjoyed our conversation today.
I did as well. Thanks for having me on.